So the headlines read, stocks bounce after their 2-day tumble. And again, it wasn't that much of a tumble when you look at it on a relative basis, and it wasn't that much of a bounce today. But we're expecting ups and downs. We're not expecting big moves. We're not expecting dramatic declines in the intermediate basis. But we are, seeing some weakness and some patterns. Weakness that will lead first to a loss of bullish momentum. Remember, you lose that bullish momentum first before you start gaining the bearish. That's the kind of mode we're in right now. I'm going to break down the charts from that perspective, as well as where we can now try to find some opportunity in lagging, underperforming areas for a trade today. So let's go ahead and get started. Today is Wednesday, January 31st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad you found us. Keep coming back day after day. Subscribe to my YouTube channel by clicking that red subscribe button right down there, right below this video. You can do that right now while you're listening. Also, while you're down there, click the thumbs up icon. That lets me know two things. Number one, that you liked it, that you got some value out of today's video. Number two, that you want me to do the video again tomorrow, or Brandon to do it again tomorrow. One click, very easy way to give us feedback on what you think about these videos. Comment on anything that stands out to you by scrolling down all the way to the bottom to the comment section. Also, subscribe to my daily email, my Market Outlook email. I send out every day time-stamped, hyperlinked summaries of everything we talk about in these videos, so you can get to the segments you want to quickly, as well as some other things that we put in there. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen up there, at DavidSettle42. Also, make sure you follow Brandon and follow Market Scholars. Even if you're not a Twitter person, if you want content like this, if you like content like this, follow and just lurk and watch. And make sure you like and retweet. Always pinned to my timeline at the top is tonight's Market Outlook. Like and retweet. The more you engage with my tweets, the more Twitter will keep pushing you all of the tweets that I put out there. Finally, join the Market Outlook community. The address is at the top. There's also a link in the description below. There's over 800 that are in the community there. So join that group and comment and engage and share ideas. That's what we're there for. It's a common group of people that all watch these videos day in and day out, just like you do. All right, well, let's take a look at the S&P 500 then with the market forecast indicator. You notice we closed right at that 23% Fibonacci level again today after gapping up a little at the open. Not quite able to get into the gap, barely, but not quite really significantly able to get into that gap there that we had from the weekend, or from Monday to Tuesday morning. So again, a 3-day pullback. The difference here is, remember, this divergence, and it's basically set this level as the target for the divergence. A break below this level would most likely lead to a trend change. That's how divergences work. So again, for those who are new, divergences, I'm looking at the blue line down here. It's lower highs corresponding to higher highs on the index itself. So for the first target, not primary, but first target, the low point in between the two highs that corresponds to the near-term low, and also in between the two highs. Now, what makes this even better is the fact that the near-term line didn't drop below 50. It stayed up above. And the next high didn't get into the reversal zone. So that makes it even that much better of a divergence. But, like I said, in one day yesterday, we reached that target. So the secondary target then is just a new trend. That's kind of like there isn't necessarily a target, but it leads to a new posture. And now, granted, the posture right now is strongly bullish, still strongly bullish. Near-term line, though, is in the reversal zone for the first time in this whole bullish run. See the near-term line? You can tell, you can just look at that blue line here. If I were to take off the red and the green lines, you can look just at the blue line, and you can tell what kind of trend we're on by where the lows end up. You can see, and where the highs. See, all the highs are up in the reversal zone. All the lows get into this level. You notice no lows here. And during this point, the highs were barely getting up there, and the lows were down. So you know that was a little bit of a pullback right there. All right, and the last one we had was kind of over here in this area where we weren't getting really significant highs, and we were getting more dips down here. So this is the first dip of the momentum line, the first dip of the near-term line into the reversal zone. So which is another kind of canary in the coal mine. And finally, the momentum line yesterday didn't quite get to extreme lows, but now is in the reversal zone for the third day. We talked about the possibility of near-term volatility. We're getting that right now. So you're going to get, see, we only have one. In fact, I have to duplicate that because now we're forming a low point. Before things really kind of get out of hand, the moving average typically catches up, and you start to get more error. You start to get more of these ovals before. When we get further away, you start to get some more of these ovals, which means more near-term highs and lows, especially considering that we're multiple months into this move. So, kind of watch for a bounce up, whether it gets to new highs or not. It doesn't really matter, but it's not going to be nearly as big as that bounce is, and then lows. And we're going to kind of, in my opinion, kind of hover between the top and around this 23% Fibonacci retracement, which happens to be the midpoint right now of the 4-week range. And also happens to be the 23% Fibonacci level of this intermediate trend that we've had going on for now 5 months. So that's kind of what we're looking at. Dow Jones Industrial Average. We can look at it here really quick eventually. All right, so you can see it's very similar chart. This momentum line did get down to an extreme low, which is another canary in the coal mine. And you can see the same divergences showing up. Not as good of a divergence because that second high got into the reversal zone down there, but still a divergence nonetheless. NASDAQ Composite, there we go, broke through a trend line. Woo, that's a really big, significant trend line, and I am completely kidding on that because of how far up above the moving average we are. But obviously, we broke through that. It's near trend line. It's in the lower half of the chart. You have the same divergence set up here, right? So highs and then the lows, which we've already hit on the intraday basis in between. And in this case, the near-term line dipped its toe above the reversal zone. So that's still a pretty decent move. So a break below these lows, where my cursor is, would lead to a more bearish posture. Momentum line did not get to an extreme low point there. Also, remember, you have like Facebook's out. The earnings were good, but the reaction wasn't so good. Microsoft as well. So look for the NASDAQ Composite to have more of a bearish day tomorrow. In fact, let's see if we got the extended hours for QQQ. Yeah. So the extended hours for QQQ, and we're watching this 167.5 level below these lows. Right now it's at 168.5, so almost a point down, almost to today's low point. So far in the after hours with Microsoft and Facebook and Qualcomm and PayPal all releasing their earnings here in the afternoon. All right, and then finally we'll take a look at the Russell 2000. And you can see it's having bigger declines. It's a riskier, and it stopped going up as much as the S&P 500 had been. Its intermediate posture is now as weakly bearish as you can possibly get. It's like the Eagles are backed up against their own end zone right now, and they have to travel the whole length of the field to score against the Patriots down here. So that they have the ball, but they're on like the one, and you see you're at the 79.5 percentile. They're basically at the 1 inch line of their own field, and that's how weak the posture is. Bearish because it's below 80, but about as weakly bearish as you could possibly get. Momentum line had got to an extreme low. Near-term line is in the reversal zone. And you can kind of see a similar divergence here with those highs. Not as significant of one. You can see the lows here at 1575. A break below these lows would lead to more of an extended intermediate run, which right now, considering the run we've had, would be very welcome. And again, for those who follow me on Twitter, yes, the odds of us getting, there's a couple tweets I put out there. This is the first one. When you are above 5% in January, there's your average returns for the rest of the year, right? What the final 11 months, the average return is 16%, and it's been higher. It's been higher the previous 11. This is the 12th time. Higher the previous 11 times, all 11. So with a 15% annual return. And if you break those numbers down, this is what it looks like here. So this is number 12 right here. This is what the rest of their years look like. The only one was 1987, where we had a 10% drop the rest of the year, but still finished the year strong. That was also the strongest January move that we had. You can see the strong ones. There's another strong one that had a decent return the rest of the year. But this one didn't quite. So you can see, like, as big a January as this was, there's been bigger. But you see also very, very strong moves. Only that 1987 is the only outlier there, but it had more than double the return in January, almost triple than what we had right now. But look at the pullbacks. 10% pullback on average. So even though, yes, we're expecting a decent year based on what we've seen in the past, doesn't mean we'll get it, but based on what we've seen in the past, we're getting decent, we are going to get decent pullbacks. And so, now we know when and how they're going to occur here on these charts based on these levels that we're actually currently sitting on. If we break through those, it doesn't mean the sky is going to fall. It might lead to an intermediate posture that we just haven't seen. A bearish intermediate posture that we just haven't seen for a while. So don't get sucked into thinking, okay, this is the end of the road, because the long-term trends are still well intact. All right, so a little bit of a harami forming here, but again, remember, that's 1 week, and we're still, even with that, we're still way up above the 50-day moving average, and obviously way up above the 200-day moving averages, higher on a percentage basis than ever on that. So you can see the MACD on an absolute basis as high as it's ever been, and when it does get this high, it leads to divergences. It grinds its way towards zero and leads to divergences. So we're not, yes, we've had a spectacular, unprecedented move, at least from these kind of levels. Usually we get these kind of moves, like I said before, from low levels. The fact that we got it here, yeah, that's spectacular and historical and crazy, but it doesn't mean that we have to reverse the whole 4-week move in a few days, right? Now, we've almost reversed the whole last week's move, but that's one of four. I mean, that was kind of the last hurrah of this 4-week move. We're still got plenty of room to drop. And we'll most likely do so in a choppy manner, ups and downs, ups and downs. As you can see here, you'll start to get more arrows as it starts to mess around with the 50-day moving average. And while it's messing around up and down around the 50-day moving average, the 200 average will catch up and flip from moving up this direction like this to then moving up this direction where it flattens itself out. All right, so from a 3 green arrow standpoint, look at that MACD down there. It's finally dropping, moving its way towards the old highs that we had. In fact, I can get rid of that line. So we're obviously the MACD and the stochastics are both below the moving averages. We are below the 8-day, yesterday and now including today, we're below the 8-day moving average. We still got to test that 17. So, you'll get, that moving average once you get below the 8. That getting below the 8 kind of stops the bullish run, the momentum. Now we fiddle around with the 8 and the 17 while the 6-week catches up. So look for, again, more ups and downs in this area here. I had a student on Twitter reply to one of my tweets, I believe it might have been yesterday, where they mentioned that they're going to sell Iron Condor. So think about that, what I just said. Expect more ups and downs, but kind of fiddling around while those lines catch up. But right now we have higher volatilities. You'll see now as we move to the other chart. So that's kind of the idea. You got higher volatility. You can sell options at that higher volatility. And then as we grind in the range that you're selling the Iron Condor around, then the volatility will start dropping again. And that's how you make your money with that particular option strategy. You're just selling calls above, like a covered call. You're selling puts below, like a short put. So you're covering both sides and just making money while it grinds. And you're making money from time decay, and you're making money from this volatility falling back from these higher levels as we grind away. Remember, again, for stuff like that, you have to, like and retweet. Now, I've always pinned this market outlook videos, always pinned to the top. So make sure you're at least liking and retweeting that one because that's the easiest one to find. But scroll down through and see other stuff. The more you like and retweet anything that you see, if it's something that you felt like is valuable or is was helpful to you, then like it. One quick click, that's all you have to do. And the more you do that, the more Twitter will keep pushing you my tweets. Because yes, you might I follow 2,166 people right now. I don't get all their tweets. It'd be impossible. So Twitter will push to me in my timeline the tweets that I engage with from the accounts that I engage with the most. So if make sure you get them and make sure you're liking and retweeting. One click is all it's needed. And what it does that's the benefit for you. The benefit for me is that you tell me, hey, you like that piece of content, keep doing more of that stuff to share with you, and I'll gladly do it. And then the retweets shows Twitter, hey, this is an engaging piece of content. Whether you have followers or not, because you retweet it, you felt it was important to share, and the more Twitter sees these shares, then they'll promote it to other people that follow me, number one, and that haven't engaged for a while, and also to other people that like that kind of stuff. So that's how Twitter works, and that's the benefit I get out of your likes and your retweets there. All right, looking at the intraday chart, you can see we tried to get up above that gap, and we did by a penny, but that was it right at the open. We weren't able to really fill that in up to that 284. So still, you got 283 and a quarter roughly as a resistance, 283, and that's some old lows in this area. We did drop. We're back down. We were dropping to 282. 282 in the after hour, or we did move up to 282.50 in the after hours. You can see the bid in the ask up here. That's where we're trading right now. 282 on this. Lower low happened late in the day. Higher, relatively equal high early in the day. So bearish candle, but not that bearish because we didn't form lower highs, lower lows. We didn't close below the low. We closed right in the middle of yesterday's range. So bearish bias, but more of a neutral candle, which is kind of what you want to see when you're on a pullback. It's funny to see the headlines like this. This was a 2-day tumble, is what I see like on TV or on the internet. So the market bounced back from its 2-day tumble. Well, the S&P only bounced up at 0.05%, and that's all. The 2-day tumble was a 23% Fibonacci retracement of the near-term rally that we had, much less the intermediate or market sentiment lines. We're not even close to any kind of significant retracement there. So yeah, that's not really a tumble. It was a pullback. That's probably the better phrase, but it doesn't get people's ears perked up. Obviously, when you say the market is in a pullback, it's better to say it's in a tumble, it's in a free fall. What should we do? Are you going to buy now? Is this the dip that everyone's waiting for? No, it's not the dip that everyone's waiting for because that's a near-term dip. We want an intermediate low point. Those produce better launching pads for us. But you can see again right at that 23%, 116 million shares traded. The range today at over 2.5 points. I don't have to worry about the gap there. So we'll look at this on a range to over 2.5 points is above the 52-week high and above the average, so still pulling it up. Volume also above its average, which is also at the 52-week high, pulling it up. So there's going to be more volatility. These levels are high. There's going to be more volatility, so be prepared for that. We are pulling back on the volatility index now. We're here at 13.5. We'll see if we end up with a higher low point around 12.5 to 13, and then we bounce back up. And if we do that, then we know volatility is here to stay for a while. If we were to drop back down below 12, then we're going to be really grinding slowly with small moves as those longer term moving averages, the 30-day and the 200-day, start to catch up and flatten out. Here's the volatility on a relative basis. You can see it's right in that neutral area, 90 to 95%. So it's not too bearish. It's not, it's not too cold. It's not too hot. It's just right? Well, that's what the volatility is right now. It's elevated because we were so low before, but it's still kind of in a neutral range where between 90 and 95%, where you're really neither either bearish or bullish. But if we start to creep back down below, to 85, which is a sweet spot for a bullish trend, or lower, then that, again, grinding away, not significant moves higher, but just bullish bias as we grind, and those moving averages that are parabolic right now flatten themselves out. All right, let's take a look at how what's driving that price action today. And this is, I zoomed in here to Friday's close. So we closed at the high of the week, remember, and then we kind of gapped down, and then we've had a few down days here since Friday's close. You can see the market was down almost 2% from Friday's close before bouncing late into the close. But you can also see the dollars here, but pretty much flat, coming down off of its highs early, right on Monday morning. We were peaking there and then pulling back. You can see long-term bond prices are starting to recover, at least on a relative basis, to stocks, and they've really been lagging. A chart that I've been looking at here that compares stocks to long-term bond prices, and you can see, it's been on a humongous increase here, pretty much since August, September of 2017. Stocks have taken off and bonds have dropped and pushed. You can see, I mean, you have to go back pretty far here And you have to. So we started this on January. How was it? Let's see here. I can't remember the date off the top of my head now. TLT started January 1st, 2002. So we'll go back, do July 1st, 2002, up till now. And get that on there. Now, if I were to throw on a linear regression, so here is here is the time frame. Oops, there we go. Here's the time frame for how stocks have done. Now, of course, this is January. This is a monthly chart now, but this is a time frame of this is as long as TLT's been in. So we're almost at that second standard deviation away from the all-time linear regression for this ratio. So again, in other words, since the middle of 2016, stocks are very expensive compared to bonds. And of course, if you were to take a look at that here since June 1st, 2016, go back to this chart here, and we'll go back a few years, June 1st, 2016, right about here. So you can see bonds are flat, essentially coming down, but they're flat. But the TLT is flat. The dollar's been down. Gold's been rallying since the dollar's been down, but all of these safe haven assets are down, and stocks have taken off. And emerging markets and gold and crude oil have been the biggest winners since that time frame. But this is what things have looked like since the ratio of stocks to bonds bottomed and has been on a tear to the upside. So now you can see why things are pulling back and what things are bouncing up. Because again, when you have a divergence like this, or whatever the time frame is, even if it's over just 2 weeks or 4 weeks, excuse me, when you have a divergence between all these lines that they all separate, then eventually they'll all converge. And so for these to converge, they have to come down. And for these to converge, they'll have to bottom out and at least stop going down, if not start coming up a little bit. And that is dollar and bonds. And you can see in gold. So that's what we've had essentially over the last 3 days. This week we've had a convergence where crude oil and emerging markets are down the most, 2%. Interestingly enough, the small caps are down more than large caps are, even though large caps have really been doing better this year to date than small caps. And then you can see all the safe haven asset classes up here at the top. The dollar flat, gold down a little bit, but beating stocks and beating crude oil. Bonds down, but beating stocks. And you can see high yield matching bonds there. So that's been the driving force right now. It's just been pullbacks. It's not been tumbles. It's not been the market's tanking. It's on a free fall. No, it's just pullbacks. And if the media would just use that phrase more, unfortunately, it would dampen the emotions from people that are watching that would think, oh no, what do I do with my 401ks now, whatever the case is, when they realize it's not that big of a deal. But we did get some news out. We had today, you had multiple things. The ADP employment report came out, solid numbers, a little bit below what we had before, but above consensus, so pretty solid numbers there. You look at Chicago PMI down from what it was, but that was like the biggest print that we've had in years. But still, you can see still above 65, so still very strong manufacturing sentiment. Remember, that's just a sentiment. That's a survey. That's not actual manufacturing. And then you can see the employment, the petroleum report showed some draws. A small build in the crude oil inventories, but some draws in gasoline. And then finally the FOMC, that was the big one. And the FOMC came out and pretty much said that we're going to have inflation in 2018. And so, if you were to go right now to the current meeting, so that would be, well, now it would be March because we just had this meeting. So this is March. We're expected to get a rate hike. The odds are getting up there. That we're going to get a rate hike to 150. And then the question is now, when are we going to get the second and the third? The third rate hike being 200 to 225, or the fourth rate hike. Let's see, it'd be this one right here. Nope, back to that one, sorry. December. Because they've been doing it on the March, June, September, December month. That's when they've been raising. And they have press conferences. They have their projections, the dot plots, all that at the same time. So this line here represents the fourth one. Oh, excuse me, this one. This one here represents a fourth rate hike by the end of the year, and you can see that's what's moving higher, is that fourth one. And for September, it would be the third rate hike, and you can see that's what's rising sharply here. In fact, you can even see a fourth one by September is rising, but that you can see the third one by September is almost higher than just having two. So the market's starting to pull up, not necessarily in March, but these later months, starting to pull up their projections for their rate hikes. And you can see one of the reasons why. Look at this is the initial GDP now forecast for GDP for the next quarter, for this first quarter, and you can see it's at 4.2%. So that's a high. Now, granted, this most likely going to come down. It usually does. So keep that in mind. But still, really, really high number for the GDP, and above all the consensus estimates we currently have for Q1. So strong economic data. Yeah, we're pulling back on the economic surprise index. We'll keep that in mind. We have jobs coming out, not jobs reports on Friday. Tomorrow we have the construction spending, the national ISM, which again is a survey data, so keep that in mind. But then you have productivity and employment costs. We'll see, if that employment cost starts to rally, because that's where the inflation really starts to hit, is when wage growth, because higher wage growth leads to so many other things: higher spending, higher asset prices, all of that is when that wage goes. So and productivity will start to tumble. And productivity ends up really low in the mature end of a business cycle. So we'll watch for the trends on this one to see what happens. You can see the unit labor cost has been low and productivity has been higher. So that kind of shows we're not necessarily yet at the mature end of the business cycle, and we'll see if that changes tomorrow. All right, so now from a sector rotation standpoint, you look at the 3 days, and the biggest mover to the downside has been that healthcare. It's been a big gainer, and just like that, look at that. In over 3 days, it's the biggest loser. And a lot of those trades we've been looking at, Lilly, remember Lilly had that strong reward to risk ratio because we were really aggressive, and whenever we're really speculative and aggressive, we position size smaller than normal because we know we have a bigger reward to risk ratio to help offset that. So that's one that just didn't work out. And Pfizer's another one that's pulled back to the levels where we initially looked at it after bouncing up, taking off and kind of breaking out. So those trade ideas have been impacted by this rotation out of healthcare. A lot of it coming from what Brandon talked about yesterday because you can see it's in the last 2 days. It was after day one, it was one of the outperformers here this week. But Brandon talked about Amazon and Berkshire and JP Morgan kind of working together for a healthcare option. And that's really impacted this sector. Energy stocks have also, those have been a big winner lately. They've pulled back, and you can see some of these sectors have been big losers, especially utilities and real estate. They've been the big winners so far this week. They're closer to break even for the week than any of these other industries are. You also have some of these other kind of matching. So those are outliers, and again, it's the same thing we talked about before. The things that move the most, that converge away the most, pull back, and the things that are down the most pull up. Whenever we've really converged or diverged like that, we start to pull back. So we ride the trends, and then be aware that those are the ones that pull back the most, and you look for opportunities here as things start to bounce back up. All right, so for our trade example of the day, I do want to focus in an area that hasn't, the materials sector, that hasn't been as weak as, let's go back to the sector charts here really quick. Hasn't been as weak as the the utilities and real estate sectors, but you can see it has pulled back. So, it started off as a strong sector, and really since about the 16th here, after peaking, it's pulled back. In fact, really actually from about right here, on a relative basis compared to everything else, it's dropped down, and it was lagging behind along with energy. It's been lagging behind the broad market and looking for opportunities. And one of the stocks that you saw that had pulled up is U.S. Steel. Let's look at this chart first. You can see You know, we had a couple of down days coming off of some grinding highs, bigger down days, 1.5 times average volume, 3 red arrows. Now, this typically is your signal when you're trend trading on these daily charts. This is your signal to move your stop order. If you had bought it back here when it started to, 3 green arrows up to the upside, then you'd have your, stop order. You'd move your stop order to below today's date, today's low. 3% below, or some ATR below, whatever it is, you put your stop order below today's low point. And then if we bounce, great. Well, in the after hours, since we had earnings come out, it is bouncing. It's up to 38.40. Now 38.40 is below today's high, so it's not quite breaking out yet. It's not like it's just we're chasing this crazy move. It looks like this is a move that we could potentially bounce from here and produce a new set of 3 red arrows. Now that's on an intermediate basis. If you look at the longer term view of U.S. Steel, obviously it's above its 50-day moving average. It had pulled down to the 50-day moving average. You see how important $40 is as a support. So if we can break through that on this area, let me show you another chart here, and you can see if you can break through that, you've got some kind of like head and shoulders, inverted head and shoulders pattern here. Then you've got 60 as a target to the upside, if not higher. And of course, we all know that that's one of the sectors that's benefited from the administration's trade policies, potentially, is the steel sector. And so, if we were to break up through 40, then you've got, this thing can trend for a while, especially if the dollar is weak, the dollar continues to trend lower. I mean, yeah, it's up, it's bouncing because it's been so oversold, but if it continues to trend lower, then a stock like this will continue to move higher. And remember, these are the industries, materials, and energy that outperform during the latter mature phases of that business cycle. So as we enter into that, eventually, at some point, then this will just start the outperformance. And you can see it's been, at the beginning of 2016, it was way down to practically nothing, $7 a share, and now it's up to 37. But if you can clear 40, you're not gonna, it's not gonna be a 10-bagger per se, but you've got potential. It might not get up to 180 again, but it's got potential to trend, break out, and getting up to $60 from 40 is a 50% move. So that's kind of what we're looking at, that possibility, and taking advantage of the intermarket relationships as well as a bullish pattern, a speculative bullish pattern on the daily, on the intermediate chart, and a position pattern here where typically you use it's for stop order movement, but can be used as a speculative entry. And remember, when you use a speculative trade, you position size smaller than normal, because if it does trend higher and you get a new higher low point, and we bounce off of that, then you can add to that position. But when you're getting in closer to the support that you're going to put your stop order below, then your reward to risk ratio will now be big because your risk is smaller than normal. Not as small as it could be because we're already moving up in the after hours, but still the benefit here is it hasn't moved up too much in the after hours that we can't now use that trade, because it's not going to produce 3 green arrows, so you're still going to be trading ahead of the 3 green arrow signal, which again makes it more speculative than normal, which again means smaller position size than normal. So to summarize, remember, when we're at the end of this intermediate runs, we'll get some near-term volatility. We'll get some highs, we'll get some lows. They'll be more frequent. Moving averages will start to catch up and flatten out. We're not going to tank typically as we head down to those. We're just going to kind of grind. It's a great opportunity to sell options. It's a great opportunity to look for potential, for reward potential in areas that have been lagging. Obviously, utilities, real estate have really been lagging, but flying under the radar a little bit has been some underperformance in the material sector, and we try to take advantage of that today. As always, thank you very much for watching tonight. I really appreciate it. Keep coming back tomorrow. Remember to subscribe, like, and comment down below on the YouTube channel. Also remember to follow me on Twitter for more content, as well as join the Market Outlook community on Facebook with all the links in the description down below. Have a great evening, everybody. We'll see you all tomorrow.